Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, March 22nd, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to cover a few different topics this week. Viper has got three. He beat me out 3x here with three 1% trades that we're going to touch on and cover. I put a couple of trades on. They don't quite classify as 1% trades, but they're very interesting nonetheless, and so I'm going to talk to you about some of those. And then lastly, I'm going to keep an eye on this ticker coin, as I believe there could be some volatility rise when it comes to coin. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You can also find all of my trades, the good, the bad, and the ugly, at thetagang.com/sprocket888. And lastly, this is available in an audio-only format wherever you get your podcasts. Go ahead there and subscribe. And if you can't find it, let us know and we will get it there. But Viper, let's talk a little bit about 1% trades. So, we were going to get back in the 1% game this past week. I failed to do that because there was a couple of premiums out there that were just a little too juicy for me to try to scale them back. They didn't quite fit in a 1% trade, so I took them, but I didn't find an actual 1% trade. You, on the other hand, grabbed three 1% trades. So let me just pull up the summary here, and then I'll let you kind of talk us through it. What you ended up doing, one of them you've already closed out. You went to that, you played it, you got some profit, and you're now $27 ahead of me. That was in FRC. And then you got two open ones dangling out there in the fish pond, looking to reel in some more profits on AMC and TFC. But talk me through it. What were you seeing there? What were you trading?
Yeah, so it's been a struggle of sorts, and kind of I've alluded to it on previous episodes of the struggle is in just kind of finding my style, my preferred flavor of, my price action technical analysis. I definitely feel that improving and getting better and spotting levels and things like that. But I'm just kind of trying to figure out where my balance is on what I like to play. There's obviously no surprise to anybody listening as far as your preference of premium selling and all of that good stuff that you have ironed out in your strategy. The last time we talked about this, I talked about scalping options on index futures options contracts. That's still a thing, but I'm definitely still paper trading that and still trying to figure out what, how I prefer to go about that. So that I'm still kind of on the back burner, occasionally tossing those around in paper trades. But I kind of took that idea. So the idea of the scalping those options in index futures, or specifically the MES, the concept there is basically buy calls or puts, so buying options and buying them when there's about to be a contraction and a premium spike. And so it then kind of becomes a premium selling play of sorts, where I'm trying to buy it, get a spike in premium, sell it. And so I literally couldn't care less what's happening on the underlying, like is generally the case with an option play. I'm just trying to scalp that premium. And obviously in the case of index futures, you get massive bang for your buck, just based on how those work. So anyways, I have that idea in my head, and that's definitely still what I'm rolling with, because this generally feels a lot more familiar to me for a number of potential reasons that I can think of, but it's just more exciting, I guess, is a good way to put it for me and for my style. I also like the controlled risk of it, where as soon as you buy, that's your max loss right there. There's obviously in option selling there's a lot of factors you need to factor in, and I'm just not quite comfortable with all those moving parts of hedging with different spreads or different straddle strangles and all that kind of stuff. So anyways, this is the strategy I'm trying to roll out. I have no idea if it's going to work. It's very interesting and exciting to me right now. I have no idea if it's advisable. And certainly we are not financial advisors, but it's something that I'm having fun exploring. So all three of these plays that have come about came from this core idea where I kind of stepped out of futures index futures for a second. And I do need to be careful because I'm out of futures. And so pattern day trading is something that can really put me in the detention house. But
you don't want to be there, man.
No.
You don't want to be there. Stay out.
So as I was thinking about this, and I think it was this past Monday that I was about to go into some paper trading, into a paper trading training session, and just kind of scope out different Greeks and their effects and stuff. And everybody in the Discord was talking about FRC. And so I went and took a look, and I was like, you know what? Excuse me. I kind of, all right, I'm in the mindset of let's just scalp this premium here. And so I decided to make a run at it. I went for a bank run. And so what I saw real quick, ignoring my markings there, was we were obviously, this is First Republic Bank. There was, even additional spotlight on First Republic Bank, because I believe they were, maybe I'm wrong, but I believe they were the focus of another potential run and bailout situation or FDIC takeover or something. So they were down significantly. You can see, we'll zoom back in a little bit. You can see this crash here from $19 all the way down to $11. A 50% bleed off. And somewhere in here was when it was being talked about on the Discord. So I went and looked, and I was like, you know what? I really like this hard crash, the elasticity of price action that we always talk about. And so as it was coming back up, I was on a slightly smaller time frame. I think I was looking at the 5-minute, but still right near the top of this bounce back. I was like, all right, especially on Monday. So Monday we were still coming off of just all kinds of processing all sorts of different bank situation news and things like that. So I was like, this is just a reactive, like I said, elastic recovery bounce. We started getting some confirmation of resistance up here, and I was like, you know what, let me just do this real quick. And I went and looked at the option chain. Again, the criteria of the option chain where I'm picking, we'll talk about in a minute, definitely needs some work. But I ended up selling the $12 put, or not selling, sorry. I bought the $12 put, and it was $4.13 when I bought it, because what my thesis was we had this huge crash down. We got this big bounce back up, and I was like, I think we're still going down. And the key to this strategy is you want to be one step ahead of the next move, because that's where your premium is potentially benefiting you to buy it cheap and then get the move to sell it at a premium. So in this case, it just happened to work out beautifully. 1684 here was when I bought the $12 put, and within 45 minutes, I was up 6.5% profit. The option was up to $4.40. It really felt like, this still had plenty of room to go down, and I'm not saying that just because it's staring me in the face in hindsight right here. I very much, I very much was contemplating I should have patience. and just let this thing go and, not keep it open past the end of the day, but like, let's just see how the day goes, because usually intraday, we're going to continue the trend, and there were zero, binary news events or anything to cause a shakeup. But again, going back to the whole challenge of finding my style and, having some losses and just a general lackadaisical lack of excitement, I was like, you know what, just take the win. Just take the $27. Like, let's go. Let's lock the win. Quick hour scalp. Can't touch it again now, at least for that day, because I didn't want to breach my pattern day trade rule and get a slap on the wrist warning. So I felt good. I was like, you know what, that I needed that. There was just that little boost of like, this could work. The entry was well thought out, the price action of the entry and all that kind of stuff. So, so I rolled that forward the next day on Tuesday. I was like, all right, let's take this. Let's do this again. Like, no, don't just take one good trade and then walk away going, I got this. I'll do it whenever I want. So I actually screened on Tuesday for some more plays. And let's see, which one do we look at first? Let's look at AMC. So AMC popped up because, this thing looking, let me zoom out here to like the hour chart. It's just looking good as far as how it normally oscillates here. I looked at it. It was around $4.30, which you can see it comes down, it accumulates, it pops up, it comes down, it accumulates, it pops up, et cetera, et cetera. And in this particular case, we were getting a nice little accumulation bowl on it. So as we zoom in here, you can see we had a low, and then we just kind of had this slow and steady accumulation up. So I like this for the same idea, for the same options premium scalping. And so I took it here around, early in the day on Tuesday morning, around $4.37 was the underlying. And you can see we had just a sideways day, and then after hours, boom, it popped up. Since then to today, it's actually come all the way back down. So still very much open and in progress. Still got the fishing rod out there. I was a little excited on the pop-up. I was like, this was perfect timing. It was mostly, the pop-up was just GameStop started doing their thing. The meme stock buyers started coming in. They could still be here. I don't know. We'll see. But I liked it for this play because the price was so far down with a history of accumulation, gaining, and popping. And that's that being far down is something I'll circle back to after we take another quick look at the third play now, which is Truist Financial Corporation, another bank play. And in this case, it was, again, similar thinking to the first bank play, where if we look at the chart, this thing, like, you can't even find the rest of the chart because it gapped down so hard. And so this chart right here, where you see this massive bleed down into this accumulation down here. So the thesis, once again, is this idea of panic oversold. This is something I'm trying to keep in my own head about this current strategy that I'm deploying here, where I am strategically seizing opportunity of panic and something that I believe to be oversold, which is pretty much the entire banking sector right now. And so it was specifically this gap down. There's a little bit of some historical price action, but you can practice your own price action and take a look at that. But it was mostly this giant gap down that I was like, I think there's opportunity here for some recovery, and on a short enough time frame that I think I can scalp some premium out of these contracts. So that was the whole thinking, and tying it back to what I just said about AMC being down with potential to gap and run up. That's definitely the underlying theme with this strategy as I'm deploying it, is finding a position where there's potential for a large run or significantly, not, blisteringly fast, although that's nice if it gaps. But relatively quickness of going up, which then kind of juices that premium up so I can scalp it, sell it, get out, and move on. So that's why I'm trying to be careful in how I portray this strategy, because it does require a lot of that understanding of how the options contracts work and how some of those key Greeks work on it. But for now, it's exciting to explore, and we'll see how it plays out, and how sustainable or recommendable it becomes.
Yeah, I mean that's great, Viper, that you got some profit there on FRC, and AMC, TFC. We'll see how that plays out. I want to circle back to FRC because that actually is one of the plays that I made as well. Like I said, this isn't a 1% trade. Thetagang.com/sprocket888. You can find this one and another one that I did on WAL. I'm actually going to pull up both those things here to kind of talk a little bit about them. But basically, I won't say I am a strong follower of the banking industry, but one of the things that I really try to keep a lookout for is panic, because a lot of times, like you mentioned, panic causes indiscriminate selling. That can cause extreme oversold conditions, and that usually brings volatility very high, premiums very high, and I don't know, call me one of those storm chasers that comes through a neighborhood to replace roofs, after the hail damage is in there and pelting everything. But when there's panic and stuff like that, that's usually where premium is going to ramp up, and that's where opportunities exist for myself in my premium selling strategy. So with all the news of the banks, that perked my ears. And of course, you shouldn't just, run into a burning building, because sometimes the building's on fire for a reason and it's not time to go in yet. And so I done some little bit of due diligence on a lot of the banking and trying to understand, well, what's the mechanics? What's causing this? What's the real trouble here? And, I don't want to discount this or make you think, oh, everything is beautiful and amazing at the banks and they're all healthy, because, there's definitely cause for concern there. But the biggest question to me, and probably to a lot of people that, have been around for the banking crisis and the financial meltdown in the, 2008, 2007, the Lehman Brothers and all that stuff, was, okay, well, what's the cause? What's causing this panic? And back then, it was really not just a run on the banks themselves, but the assets that the banks had invested in were very, very tilted to high risk assets, the mortgage-backed securities in subprime and all this like stuff that probably was likely to default and things like that. And if we looked at the bank situation today, a lot of what was causing the problems here was people were starting to try to withdraw funds from the banks because they had fear of the bank's ability to hang out, things like that, which was effectively a liquidity crisis. And the banks were having to sell these assets that they had. Now, they weren't really subprime assets or these, mortgage-backed securities, things like that. They're U.S. Treasuries. U.S. Treasuries are pretty much guaranteed that, hey, in X number of years, you're going to get this money back. And the problem was these financial institutions were putting a lot of money in these longer dated treasuries, so they can't just pull the money out. So when the depositors come in and ask for all their money, they're forced to liquidate some of these things potentially at losses and things like that because it's before the maturity. And so that's an interesting dynamic, and especially with the federal government kind of coming in saying, hey, we're going to extend some protection to depositors, so please don't worry, please don't pull your money out. It just felt different. And that's not to justify it, but that's just some of the things that went through my head to say, is this something that is really I should be freaking out about, or is this potentially something that might just be a little bit overhyped right now and overblown? And, time will tell if the building is still burning or not. But that's what kind of gave me interest to start looking at these opportunities here in the banking world. And FRC was at the heart of a lot of this. FRC was this bank that has lots of high-end depositors, big dollar accounts. So it's one of these banks, and this is, if you look at the banks that really got whacked hard in this thing, they're banks that have a very high ratio of depositors that are in excess of the FDIC insurance. So the FDIC insurance, covers depositors up to, I think, $250,000 per individual depositor. And Over that, it's just not insured. And so the banks that have a high number of depositors that are over that rate are the ones that were getting hit the hardest, because they're the ones where people thought they're going to come in and try to pull their funds in excess of that FDIC insurance limit to go put their money somewhere else in some other bank. And, that can create that run on the bank, that liquidity crisis where the bank might not have enough capital on hand that's not tied up in longer dated assets to fulfill those withdrawals. So, long story short, that gave me confidence to start looking for these high volatility plays. And I'm going to pull up the chart here. This is FRC. This is the one that Viper got in. You can see just a few weeks ago, FRC was trading in the 120s. In the past year, they had a high of 174. And then all this news came out, and all of a sudden, we're looking at a stock that's trading, $15, $16. So just dramatic loss in value, which causes just a massive spike in volatility. So this lower chart here, it's kind of green and red, Christmassy color. This is the volatility of FRC over the past year. And you can't even really tell that volatility was registered before March 9th. But March 9th, you start rocketing up to over 400% volatility for a bank stock. That is like 10x what volatility normally is for that. And that just really just drives premiums through the roof. And to give you some crazy range here and an aspect of this, I'm going to switch over to an option chain P&L chart of my trade. And so what's shown here is this blue line is my P&L chart. I actually sold a $19 strike. Okay. And that $19 strike, we're now sitting at about $14 right here in the center of these two yellow lines. This right yellow line and this left yellow line are a 10% move in the stock. Okay. And this is where it sits on that volatility or on that P&L chart. And if you go all the way to the strike, we're talking massive percentage move before I hit even my break even, which is like 1150. And the crazy thing is with this volatility here, this gray shaded area is the one standard deviation move or expected move statistically that this option or this underlying can incur. Not the option, but where the price range is. So the option chain from a statistical standpoint is saying this bank stock could go as low as $1.50 or as high as $21.50 in the next 28 days. To see that much range on a bank stock is just crazy. So I was able to come in here and sell this $19 put for $7.20, which is ginormous as far as premium goes. And could it bite me? Maybe, but the thing is this, even if I get assigned, that puts my assignment price down here at $11.50. A ginormous discount to that $19 strike where it was. And if we start stabilizing here and not even moving, even though we are, $6 below my strike price, I still walk away a winner at $212 or $2.12 where it's at if the price doesn't move. Now FRC, you can see if I switch back over to the option chain, to the chart, its volatility really hasn't started to come down yet. And that's a risk. This could still keep going up. The other financial instrument or company that I traded was Western Alliance Bank. And you can see here, again, the same drop off that First Republic had. A little bit of a rebound. Not from where I entered, but look at this volatility. We go from around a 40% volatility all the way up to 400%. But now we're currently at 191%. So when it comes to this trade, we are just about at my strike price. Keep in mind, when I sold it, the strike was well below where it was trading. We are about at the strike price. So I've gone down in price, yet with that volatility contraction of that 400 level down to this 200 level, 50% cut in volatility. I'm currently up almost 30% on that particular position. So Viper, I guess one of the things that I would kind of call out about your first trade is as great that worked out for you in FRC. And I think you really had the direction right. And I don't want to discount your strategy because, whatever works for you is great. I would caution that strategy a little bit because you kind of were dealing with what I would consider an extremely volatile stock. So premiums are quite high, and the way you're playing it is you're buying the premium, looking for a premium expansion. Volatility expansion will get you that. Movement in your direction will get you that. And so both of those things will help you. But you have to be careful because if you're already at historically high volatility, if you get any contraction or any movement away from your price or your strike, that value of that option will quickly disappear. In particular, the shorter the dated the option is.
Yeah.
In FRC case, you got, I won't say lucky, but basically volatility didn't contract. But had you put a similar trade on WAL, which was the second example I pulled up, where that volatility crushed 50% in a day, you have to be careful about that.
Would you say in that case it's paying very close attention to the IV percentile when evaluating whether or not to do my strategy? Or is there something else?
Yes. No, I think that's a great place to start. And the other piece that I'd add is if your theory is a lot more based on price movement and confidence in that price movement, kind of that volatility contraction you can kind of deal with a little bit. If you know you're going to rocket towards your strike price, like that will completely drown out theta very strongly. And so I think if you get the direction right, that doesn't matter as much. So it's a little bit about being cautious about if you get the direction wrong, how long do you give it to work itself out? And I don't know the answer to that.
Yeah.
But I do know that mechanically, it's short-dated options. Theta is going to burn away quickly. And if you're already, so there's two of the Greeks that are going to factor into the price of that option are theta, time to expiration, and volatility. And if you're going to approach expiration quickly, theta is going to decay quickly. So I wouldn't want to hang on for too long. Volatility, if you're already in an extended volatility state, you're more likely to have contraction. As soon as you get volatility contraction, you're going to get price droppage. And that's the factors that I think you have to be cognizant of.
Yeah. Yeah, that makes sense. And I mean, because so an analogy that came to my mind as to what I'm trying to do, because I was like, like AMC, for example, doesn't really, like if we went and looked, it probably doesn't fit quite, the volatility of the bank thing. But so when I looked at AMC, what I was looking at was obviously that slow accumulation. So knowing the mechanics of the options, I felt pretty good about that volatility being low. I think I might have briefly looked at the IV percentile, but I didn't look at it super closely. And so the analogy in my head is like, I want to buy a can of soda before somebody shakes it up and then sell it to somebody else to open, or what. I don't know how to finish the analogy. But I completely agree and certainly need to take into account whether or not I'm potentially buying a can of soda that's just fallen off a truck and is coming to me super shaked up already, because then I'm not going to get, like you said, that's high risk. And part of why I think I bailed out on FRC, again, I'm fine chalking it up to 90% luck and 10% the PA read of the next price move. I think part of why I bailed out was I really wasn't super thrilled about buying at $4.13 or whatever, and then whatever that was. I mean, that's a large contract.
A huge premium. Huge premium.
Yeah. So AMC TFC, that was 25 cents, 35 cents. Like that felt, again, this isn't how you should enter this. It's just, oh, it feels right. Like, but 25 cents, 35 cents, that felt a lot more tolerable, at least from the risk tolerance level. But it makes total sense what you're saying about making sure that can isn't shaken up when I buy it, because then I'm playing all kinds of dangerous games, especially if it's a $4 premium.
Yeah. Well, the AMC trade, I actually like that one. So, I mean, whether or not you intentionally looked at the IV percentage or not, the IV percent ranking of AMC, I did happen to look at it while you were kind of talking about it, is low. It was at 27%.
Okay.
So it's not super low, but it's much more in that range where you're not as likely to get volatility contraction. You're probably a little bit slightly more likely to get volatility expansion, which helps you out in that case. The only thing you'll have to be aware of in that AMC trade, and this, I don't know this magic number, but I do know you got to watch out for that theta, because hanging on to those things for a longer period of time means several days. If your expiration is just 2 weeks away, you're holding on to it for 10, 15% of its life left in it, versus looking at an option that's dated much farther out where that theta decay is less.
Yeah.
And honestly, 1 day's theta decay, not that big of a deal if your price movement is happening and you can overcome it. So in AMC, I like it a lot more because you didn't really have the volatility working or potentially working as much against you as in, FRC case or even TFC case. Volatility was a little bit extended when you jumped in that one too.
So the last thing I'll say, and this is just kind of somewhat just me learning in real time, it's what we try to do here. So I'm glad that, at least to me, I hope it portrays in the show, that me learning in real time and kind of geeking out for a second on the mechanics of options. I feel like the play as I've outlaid it is not, it's literally the antithesis in a complementary way to the options plays you like to take, where it really boils down to your options plays. You're trying to get juiced expansion and play the contraction, and at the end of the day, you kind of don't care about the underlying value, the underlying asset's price. You do a little bit, but for the most part, and it feels like this play that I have is the exact opposite, but still the same idea, where I'm just playing low volatility and then looking for the expansion. And so I think that's pretty cool. I think one question that I'm going to let continue to sit on the back of my mind as I go through this, let me know if you have any thoughts now in the immediate time frame. I feel like the question I need to continue to analyze is, while I'm doing this for the contained risk of when you buy a contract, that's it, you're done, that was your loss. You take your loss up front. Obviously, on the flip side, when you sell a contract, you haven't realized your loss yet. You've kind of taken a credit, and now it's how do you manage this credit? And that can feel a little weird. Maybe that's why the buying side feels a little more natural to me. I like taking that loss up front and then working something out of it. But what I want to analyze as I go through this is if it's working, and B, if it's efficient, because I feel like in the back of my head, I need to evaluate if I'm making this more difficult than it has to be, meaning if I should be entertaining different types of straddles or strangles or things like that maybe are built for the kind of thing I'm trying to do, versus just plowing into just buy, that sort of thing. But kind of, I'm going to try to evaluate that as I go on, as if this is appropriate or if there's other strategies that more efficiently do what I'm trying to do, I guess is what I'm saying.
Yeah. First, before I kind of comment on that, I will say you're 100% correct that your strategy you just laid out and mine are completely opposite, but both can succeed at the same time. And one of the things that I've tried to do when looking at price action is to identify a price action on a particular chart and then say, okay, what vehicle do I play this with? And that's where I look at volatility. If volatility is, potential for an expansion, then maybe I'm going to buy options. Maybe I'm at the bottom end of a swing, and volatility is going to expand potentially. Maybe I like the premium selling because volatility is elevated. You can play both sides in both ways based on the same price action, which is pretty cool because whichever vehicle you're more comfortable in and you feel better in, yeah, do it that way. Your second point there, as far as which is most efficient and what do you look at and things like that, I guess I don't really have a direct, oh, you should do this. I would say probably one of the things that you should pay attention to as you go down this trial on these buying options is pay attention to the delta in which you buy, because that should roughly represent your probability of success. And so when you are buying your options, what was the delta that you bought? Did you buy a 20%? Did you buy a 30 delta? Because that is roughly your probability of success. Where you sell options, you're basically looking at the inverse of what you sold. So if I sell a 30 delta, I have approximately a 70% chance of success. If you're the one that bought the 30 delta, you're looking at probably a 30% chance probability of success. And so I think that might be an interesting metric for you to keep a track of as you kind of experiment with that, because that might lead to some of your questions that you're asking.
I guess that kind of gets into where maybe I'm overcomplicating or misusing, because in the case of delta on buying, that's the percentage of success of my coupon, my contract being good and redeemable for something. Which
Correct.
In the case of scalping the premium and trying to get premium expansion and then get out, that's like I'm trying. To me, if one of these contracts gets in the money, then that's bonus. Like I'm. It's almost like I'm, and this is where again my concerns of efficiency are if I'm misusing. Like it feels like I'm using your put selling strategy of sell far out, close it up before 14 days to expiration or around there. I'm kind of applying a similar thought process, but now doing it on the buy side. And so in that case, it's still good to pay attention to the delta, but I don't know that I see it as my probability of success for the, getting that contract expansion. But I guess there's probably not a Greek for, are you going to make money in the short term?
And there's not. And remember that delta isn't really the 70% chance. You're right. It does represent a 30% chance of in the money, 70% chance out of the money. And because in premium selling, anywhere out of the money, and you're a full winner.
Yeah.
In the other way around, you kind of you're the Greeks are fighting each other in your case. Okay, your theta is dropping, and you're hoping that your delta and gamma will continue to increase. And if they don't, they also need to increase enough to overpower the loss of theta. It's just a different way. I guess I don't know. I won't dwell on it too much because I probably don't know a great explanation in it.
Yeah. And I guess the last thing I'll say, because this is just to myself out loud, I came about this strategy, again, like I said, on index futures. And so it is quite possible that I'm misapplying them to equities, because in futures index options, those premiums move so rapidly and fluctuate so much. That was the whole appeal to playing this strategy in that market. It very well may not fit in the equities market for everything we've talked about.
So along with premium selling, and opportunities and volatility expansion, I will tell you the one thing I am really looking at as of this moment today is coin. That is Coinbase ticker. They were really kind of on the up and up here. I'm just pulled up their 1-year chart. Volatility isn't anything special. It's about 116%. That's about where it's been for the past year. So there's really nothing here that's like, oh my gosh, it's elevated. Oh my gosh, I need to sell this. Except the news that came out after the bell today. So at the start of the open today, Coinbase was trading around $85. After the bell, the SEC basically delivered to them a Wells notice. And a Wells notice is a document that basically says, hey, we're just letting you know, we think you might not be playing by all the rules, and we are going to launch an investigation into this. This coin has long been at the center of this. What is SEC going to do with crypto? Is it an asset? Is it a commodity? How do we regulate it? How do we do it? They've largely been unanswered. And this serving of this notice to coin is kind of a shot over the bow that says, yeah, I don't know how much we're going to discuss things with you. We're just going to start, litigating with you. And so that right now, after hours, coin is now trading at $65. So that thing just dropped $20 from the open, which is very, very big move. And so I am going to pay close attention to coin because the volatility in coin should really start taking off tomorrow. I'm guessing the volume is really going to ramp up tomorrow. And this is probably something where I'm going to look to potentially sell premium. Maybe if it gets down to around the $50 strike or so, and see where that premium elevation is. Viper, I know you probably follow this, and that news probably meant something completely different to you because you're not typically a premium seller. So you probably heard something else. Did you read up on this?
Yeah. I think at this point I would call out anybody that hasn't gone back and watched our crypto regulations video. I feel like, I need to go back and watch it again to see exactly what we talked about, but I feel like it's aging amazingly well.
Yes, it definitely is. I'll link up above in the description, right in the link above. You can click it and watch that video.
Yeah. And so there's a lot, just trying to hit some of the bullet points here. Obviously in the crypto sphere, there's all kinds of, conspiracy theories of, the SEC is trying to kill crypto and they just want to snuff it out. And that's the extreme end over there. And the other extreme end would be, nobody's exhibiting this, but the other extreme end would be like, it's whatever. It's fine. It's just going to keep doing its own thing. And we talked about on that episode, we're going to find ourselves in the middle eventually, somewhere between there. But I will say the one thing that I'm starting to come around to on the skeptics and critics of the SEC is the way that they're going about all this. I'm starting to understand why people get so concerned and anxious. While I'm not on the camp of they're trying to kill it, I'm definitely coming around to the camp of they're just running around with their hammer trying to beat, all these different things that without providing clarity. And so I started to make this shift when Kraken was sued or fined. I forget the exact number. I won't try, but Kraken was fined a whole bunch of money for their staking program that they offered. Kraken, also a U.S. company. And what really agitated me about that situation was the CEO of Kraken was complaining about how everything went down. And in my mind, he never came with the receipts. He was like, we've tried to have conversations or we've tried to register, as a security or, but they won't. And, in my head, I was like, just show us, just tell us the story, back it up what you're saying, because we need to know that, as a general public of what not just taking everybody at their word or whatever. But so that was long missing. And so in that case, I'm, going to potentially at that time kind of sided with the SEC of like, okay, you had this staking platform. You never provided transparency of where these staking rewards came from, yada, yada, yada. So what I love about the Coinbase situation is Coinbase is really standing up to this. I mean, in a productive way, not in a rebel way or anything like that. And so the SEC is coming to them, like you said, with this Wells notice, and Coinbase is basically responding, going, "Come on, guys! Like, are you serious right now? Like, Coinbase has made no secret about how much they want to work with regulators to figure this out." And then in Coinbase's official response, they did a blog post about this whole thing, and they've called out exactly what they've done to date with timelines of we've contacted here, we've met with them. It's something like 32 times over the last 9 months or something like that. And they've stated they're basically portraying the case of what they've experienced. And what they've experienced is somewhat chaos, where it feels like they're talking to people in the SEC and going along and getting responses. And then all of a sudden they stop getting responses, and like almost like there's this internal battle of how to handle them. And so Coinbase calls out one of the things that I like that they called out and are bringing to light. I mean, not that it's hidden. So the Voyager case, we talked about this one a while ago, but the Voyager case was the SEC did the same thing, went after Voyager, suing for their staking program. And a federal bankruptcy judge has actually ruled on the case, and the judge provided some commentary in his ruling. And so in the Coinbase blog post, he mentions federal bankruptcy judge Michael Wiles in his recent Voyager case shared his findings in a ruling against the SEC that makes clear that the SEC is on shaky ground when it comes to the commission's recent views of cryptocurrencies being a security. Judge Wiles stated in his ruling, quote, "Regulators themselves cannot seem to agree as to whether cryptocurrencies are commodities that may be subject to regulation by the CFTC, or whether they are securities subject to securities laws, or neither, or even on which criteria should be applied in making the decision. This uncertainty has persisted despite the fact that cryptocurrency exchanges have been around for a number of years." And I feel like that summarizes the exhaustion of the courts already. The CFTC has come out many times and testified to Congress directly. The CFTC has said the SEC has no business here. This is a CFTC matter. These are commodities. Ethereum is a commodity. And so bringing it all together, what I'm really hoping out of this Coinbase tuffle is Brian Armstrong, the CEO of Coinbase, mentions many times in this blog post. He says, "We have done nothing different than when we applied to be a publicly traded company, and the SEC, approved it. Like their staking program, they spelled it all out, how they will evaluate new listings on the service. It was all spelled out in their initial plans to be publicly traded, which they obviously are, and the SEC approved that." And so he's calling them out on all of it and saying, "Hey, you approved us before. Why is this a problem now? Why won't you sit down at the table? Why can't we talk about this? Why can't we go through Congress and legislation to get this regulatory clarity? Why are you running around trying to enforce, trying to get clarity through enforcement action and that sort of thing." So I think we kicked up a gear now, and this is getting the popcorn. If you hear it, my popcorn's done. I'm gonna go start checking it out, because I think it's getting good, and I really, really hope we finally get some clarity. It's going to be a long, battle, but I'm very interested to see where this goes. And I think the last thing I'll say is, if I'm making any predictions or prognostications, I would suspect there's a lot waiting on the Ripple case, the SEC v. Ripple. which has already been through court and is just waiting on final judgment. I feel like that's going to be a floodgate moment. However that ruling comes out, if the judge rules in favor of the SEC, then then the floodgates are open for the SEC to finally have some measure of legal standing to continue what they're doing. If the ruling comes out against the SEC, then the CFTC can kind of sweep in. But if it sounds confusing, if it sounds frustrating, it's because it is. And everybody that wants this thing to be legit just wants the clarity, and it's really hard to get that right.
Maybe you'll get some clarity from this, and I'll get some nice premium to sell. Either way, maybe we'll come away winners.
Yeah, I mean, I'm gonna look at. It's been a while since I've done any naked put selling, and so I'm very interested to see how we look in the morning, because I guess it's still like $60. That's still pretty high for a naked put, but I'm definitely gonna be watching as well.
Yeah, I don't think the opportunity for entry is going to be tomorrow, but I think in the coming days, let's keep an eye on it and see what happens.
Yeah.
Well, that brings us to the end of this week's episode. Again, we got those 3 1% trades by Viper. A little bit of explanation and an interesting thing going on when panic is out there with the banks in my FRC play and WAL play. Albeit not 1% trades, they are legitimate trades that I took, and I'm really interested to see what type of volatility contraction we get on those. And then lastly, the volatility is on the rise on the horizon there with Coin, and the SEC with enforcement against Coinbase on infractions that they feel have been had, and Coinbase says, well, we just kind of want to follow the rules, but you haven't made the rules clear. I'm not sure how that defense will hold up in court, but I guess it is a defense. So time will tell. We didn't even touch on the interest rate move today. Fed raised 0.25%, and hinted at maybe the end of the interest rate. So who knows what type of next market environment that might bring. But keep your eyes out there. Pay attention. Good luck. And remember, think outside the block.